Canada is booming. Despite all the challenges that we faced in 2025 from an economic perspective, Canada has decided to, sort of get its act in order and has basically driven a lot of foreign demand for investment in Canada. The government is running big deficits, and there's a lot of products that need to be hedged. Our futures are really responding well to that type of demand. In addition, we saw very vibrant equity markets, and the corollary on our equity options and our equity futures contract was also really, really good. Our average daily volume was up a little over 20% for 2025, and the measure of adoption and how people feel, taking risk and keeping risk in our markets is by measure of the open interest, and that was up 33%.
Where do you see new liquidity coming in from?
Canada is relatively small on a global scale, 2.5 to 3.5% of MSCI weight. And in a lot of cases, global investors for years would have just decided to overweight Europe, and not necessarily focus. When you start taking the US out and then you look at Canada and what that represents, it's actually close to 14%. So there's a greater and greater focus on the Canadian market from an opportunity perspective. The mining sector and a lot of the rare earth and precious minerals and the mining sector has been absolutely booming. So a lot of that cash is kind of coming into Canada. We also see a very robust pipeline from a capital formation perspective that we have not seen. We had that kind of year last year that we would not have expected. So all those investments are driving portfolio managers to want to take risk in Canada. Where one uses risks, they'll want to balance that risk with our interest rate products or our futures and options contracts on our equity suite to help balance that.
What were your standout trends for interest rate derivatives complex in 2025?
Timing is everything, right? And we've been spending the last 5 years rebuilding our interest rate suite of products to meet the demands of clients. And when you build these things, you don't know what the next cycle will be. And 2025 was a year of rate decreases, and the suite was perfectly welcomed by clients and used to hedge a number of the different trades that they wanted to do. Our Cora complex, which had just been rebuilt, by far exceeded the type of demand that we had originally planned. And that's largely in function of the fact that the Bank of Canada was kind of moving rates down over the course of the year. A lot of adoption. Our 2- and 5-year contracts, again, another opportunity to hedge and to take risk positions, but a little bit further out the curve. And our 10-year has always, been very, very robust. Our interest rate products, we've seen significant adoption. It actually drives where price discovery is being done around interest rates in Canada. So that's a pretty significant transformation for where we were 5 years ago.
What new interest rate products are on the roadmap in 2026?
The work around completing the rates complex is largely concluded. When I mean the rates complex, it's everything that pertains to risk-free rates. Some tweaking around the edges in terms of longer tenure Cora contracts to be able to get a little further out on the short-term curve. And our 30-year, which was relaunched a few years back, probably needs additional tweaking in order to have the full robust suite of products. So those two things you can hope to see happen throughout the course of 2026. The next phase is we need to look at other areas other than just the risk-free rates. You need to kind of focus on credit. Credit, we've spent probably the last 2.5 years working with industry to help create and curate a credit contract that will really meet the demand of investors. So we've partnered with one of the significant index plan sponsors that plan sponsors follow in Canada, which is FTSE Russell, around everything fixed income. They are a very important player. We've announced the launch of our credit futures contract that will basically see the light of day in early April. Now, this is a unique spread product that will allow participants and investors to hedge a subset of, from a spread perspective, to hedge some of their credit risk around Canadian financial products. It's an index, again, that was curated by FTSE, and this is kind of the first foray into that part of the market. A lot of Canadian investors have been using sort of a dirty proxy and using CDX in the US. The correlations relative to how Canadian credit markets work, it was like I said, a dirty hedge. I think this will probably be a lot more reflective of the true nature of Canadian credit. We hope to see great global demand for this new product.
Which equity group franchise grew the most in 2025?
Options on ETFs have done exceptionally well in 2025, and we see probably some ongoing trends of that continuing into 2026. The CDR options, obviously giving Canadian investors the ability to do away with some of the friction in terms of trading options in the US, now have access to a whole suite of sort of big stocks like Apple and Amazon in Canadian dollars, and these CDRs, which they are essentially a form of a single stock ETF, you have the ability to now trade options on this. And that has basically brought a lot of activity to our platform.
What is fueling the growth in Montreal's overnight trading?
The products perform very well through good market making programs, not only during, sort of the core of our North American hours, but also in the extended sessions to have deep liquidity. And this deep liquidity is allowing participants who feel that it is the right price to actually take risk or offload risk in hours that are sort of outside of the realm of North America. Global news and wars don't, use the cues of when the markets open in North America to happen. You have to meet the demands of the clients at the time. And I think having spent a whole bunch of time setting these products up for success, we're now seeing the results of this. When we see extreme volatility in the markets, our sessions, even over the course of the last week, have seen sort of record spots.
Where's the overnight demand coming from?
Either be from North American folks that have positions but see the markets trending in a particular direction, using the liquidity to kind of hedge. It's about international clients who also want to use these windows. If you look at a lot of the sovereign wealth funds, if you look at the Australian superannuation funds, if they need to make moves in their time zone, they will have the liquidity of both the Asian extended hour session or the European session to kind of extend their window of liquidity.
How has AlphaX US performed in its first year?
I've got to say I'm exceptionally pleased with the performance. If you look after 3 months where we were, after 6 months, after 9, and after a year, where we were from a performance perspective relative to similar markets that have launched, we were well ahead. And the client adoption has been very good. The response of clients who are using this platform, the data markers around the usage, we didn't want to be sort of, one of these venues where you're just kind of catering to something that is en masse. This is something that is very unique. It's catering to quality of execution. There are a limited number of venues, and I think we really differentiate ourselves by the simplicity of connectivity, the simplicity of use, and the simplicity of execution.
What does the new office in New York signal about your global ambitions?
Just to give you a sense of where we were probably 2 years back, you could gather the entirety of our U.S. operations around a dinner table for 8. And now, we've got probably more than 100 odd people at 225 Liberty, which is our home. When Canada sits so close to the most liquid market in the world, the lessons that we've learned is you cannot have these massive market structure gaps in order to remain competitive. So 24/5, just like we've done for our derivative business, you have to work from an industry perspective. The U.S. has signaled now that this is happening. It's happening in June, whether people like it or not. It's not unanimous in the U.S. that this is the best thing to do for the most liquid markets, but it's a trajectory in which the industry is going, and they need to move in that direction. So from our perspective, we feel that we need to take a leadership role and take the same kind of industry approach that we did for our derivative business. You need to factor risk in, to factor issuers. Like in a lot of these discussions, issuers are not even being brought to bear. How these issuers are going to do public disclosures. If you're running 24/5, when do you do disclosures? It's certainly not going to be on weekends. We are going to take a leadership position to bring the best solution for the Canadian ecosystem.
What are your thoughts on tokenization?
I'm a big believer that it probably brings more advantages as it pertains to post-trade, capital mobility, capital efficiency. And the irony is that we made some significant investments in Canadian Collateral Management Service, which is one such example. It's not digitized, but nothing prevents us to digitize that. We basically also created secured general collateral notes probably 2 years ago to meet the demand of BAs that were basically being replaced by CORA, and BAs were disappearing. When you're digitizing these different assets, the nomenclature on how you digitize them is very, very tricky. So you have to have consistency. Going ahead of the US would make no sense for us because, again, you need to be fully aligned. DTCC now seems to have a clear path. They've been working with some consultants on the path of travel. We now have something to align ourselves on. We have the privilege of overseeing the equivalent of DTCC in the US, which is CDS. We are also using the same consultant that DTCC has used, and they still have 4 or 5 weeks worth of work. Once that concludes, we will basically take the best measures to make sure that the Canadian capital markets remain competitive. One of the most significant things we kind of have on our roadmap for 2026, and to be perfectly candid, it was not on our radar at mid-year last year. So that's how quickly things are evolving.